Hey, Mr. Max. My name is Barakat, and here's the explanation for the exam that you asked us to do. The first question is a process costing question, and one of the first question is, a soft sweet drink co. is a manufacturer for a popular soft soda beverage. It has just ended the following process right on the year end stock and valuation period. So one of the first questions I was asked was, what is the estimated cost per unit? And cost per estimated cost per unit, or cost per unit, equals to total fixed cost minus total variable cost over total units produced. So to find some of the elements within the question, we first look for the total fixed cost, which is direct materials plus conversion cost, which equals to 8,900 plus 8,000, which equals to $16,900 dollars. And the total variable cost is, or expected scrap, is normal loss multiplied by scrap value per unit, which equals to 2,000 times 0.5, which equals to 1,000. So by putting the found elements of total fixed cost and total variable cost into the formula, we can get cost per unit equals to 16,900 minus 1,000 over 18,000, which equals to 0.88, which is the cost or estimated cost per unit. Going into the second question, we're going to have to go to Excel, and within Excel, I have prepared the process and related costs uh, of the production, which I have divided into three parts. The first one talks about the process, or the process of making the product, which has two different sets of processes. The first one is the actual creation of the process, or actual production of the process, which we have found, but there's an added element to it where you can see over here. Let me zoom in a little. Yeah, where you can see that the abnormal gains have been added to it. So abnormal gains are the unexpected or unknown costs that we have to add within the the production cost, which makes it 21,850, which is for the units, which means 21,850 units have been added to this production, as well as the abnormal cost as well. Considering the abnormal cost, which is $1,634.17, which we add to the conversion cost and material cost amount, which is 8,900 and 8,000, which gives us 18,534.17. Looking at the related some of the related costs on this one, you can see that the normal cost, it's 2,000 unit 2,000 there's 2,000 units at a rate per unit of point at 50 cents, at an amount of $1,000. Also, units transferred out, which is 19,850, which is the finished products that we have sent out, which at a cost of 0.88 per unit, because we had calculated the cost per unit, which equals to 17,534 point 17 cents. So when these are some of the sub totals, and when you do the total for both processes, you can see that they're equivalently the same, which means the units are 21,850, and the amount is 18,534.17 cents. So you can see that the production cost and the process costs are similar. Also, there's normal processes, which includes the processing the material, which is 2,000 at a cost of 50 cents, for an amount of which in total was $1,000. this is just the production cost that we had, or that we had. This is the material cost that we had already seen, but some of the related costs that that we have to see is it's not very clear in the video. I think you'll be able to see it with the Excel file. So for this one, you can see that there's an abnormal gain which we had already done, which is question 3 of the in the test. But here you can see that the abnormal gain is 1,850 at a rate per unit of 50 cents, which has a total amount of 9,200. $925. Then there's the cost ledger control, which is 150 units at a rate of 50 cents, which has an amount of $75. And these are the subtotals of the process, and you can see that the total is 2,000 units for both, at a rate per unit of 50 cents for both, at an amount of $1,000. Lastly, for this question, there's a question of abnormal gain, where the units are the normal loss is 1,850 units at a rate per unit of 50 cents, which total amounts to 925. And the cost ledger control, which is 38 cents, at an amount of 709.17, or 17 cents. And you can see that the total cost totals to 1,850, at a rate per unit of 88 cents, which totally amounts to 1,634.17 cents. The same process is used here to this is the abnormal gain, because we have already seen how we get these numbers from the previous examples. So you can already see that this process is 1,850 units per at a rate of 88 cents per unit, at an amount of 1,634.17 cents, which in total is the same as the normal loss and cost ledger control combined. So this is the process that we have used to create a related and to create a process and related transaction product. The third one is abnormal units. So for abnormal units, abnormal value equals to actual output minus expected output, which equals to the actual output is 19,850 minus expected output, which is 18,000, which equals to 1,850. The abnormal value of the company is 1,850 units, which basically means that the company was not expecting to produce this much amount of money or to be as productive as they thought they were going to be. And there's an abnormal value, or an estimated or an unknown variable within the production of the company, which caused them to create 1,850 further units. For the second question, it says calculate the selling price with profit margin and using profit markup. So the question reads: the accountant has calculated that the total cost of project J with cost card guide is $1,250, and now the accountant has some doubts on figuring the final selling price of project J with the following requirements from the manager. So the first one is calculate the selling price with profit margin of 20%. So to find the selling price, we have to look at the formula of how we get to selling price, which selling price equals to cost price plus profit, or margin of profit, profit of margin, over 1,000 times cost price, where after you do the processes, which means eliminating selling price equals to 100 times cost price plus profit times cost price over 100, which finally gives us the formula that we need, which is selling price equals to 100 plus profit percent or profit margin times the cost price over 100. So using this formula, we see that the selling by putting in the variables, which we know the profit margin is 20%, which we know the selling, the cost price is $1,250. We can get by adding these variables, it's 100. Selling price equals to 100 plus 20 multiplied by 100. 1,250 over 100. So selling price becomes 120 times 1,250 over 100, which makes selling price 1,500. So therefore, selling price of the product J is 1,500. So this is how we get the selling price using the profit and margin, which for this example was 20%. And by plugging in these numbers, we have found that the selling price of product J is 1,500. But so the second one is calculate the selling price of the product product with profit markup of 20%. So the profit when you're looking at profit markup, the formula of profit markup is markup equals to selling price minus cost over cost. So we will just take out selling price from this equation, or we will try to extract selling price, and by shifting the numbers to the right side and taking selling price to the left, we'll try to calculate our way around it. So 20%, we know that the markup is 20%, but we do not know the SP. So 20% equals to SP minus 1,500 over 1,500, which sorry for that, which yeah, which when you look at it, I don't know why it's so blurry. Yeah, which when you look at it, you can see that we have taken 1,500 to the left side and multiplied it with 20%, which gives us 250, which equals to SP minus 1,500. And by taking negative 1,500, negative 1,250 to the left side, we get that selling price is 1,500. So therefore, the selling price of the product J is 1,500. But you can see that the selling price for both the calculations is the same, which is 1,500 for both the for both selling price, the selling price found by using profit margin, and the the selling price found using profit markup is the exact same, which is 1,500 for both. Now we go to the third question, which is investment appraisal theory and calculating the present value. So before we go to calculating net present value, let's look at the concept of investment appraisal. Investment appraisal is a technique used to provide financial analysis to help investors and management to make informed decisions on whether an investment on a future project is worth the investment required. So as management, there's an essential part. The essential part of their job is to make investments that is worthwhile for their investors, meaning that the company must make sure that the investment that the company undertakes ultimately benefits the stakeholders or investors or whoever is involved in the process of investing. So investment appraisal is a very important technique that we use to make analysis on finance and finance and the general in general part of the investment, and make make smart decisions based on that analysis, so that we can make profit or be as profitable as possible. So within investment appraisal, there are different techniques that are used, and one of those techniques is called net present value. So net present value, as a definition, is the net present value calculates the monetary value of now of a project's future cash flow. To make this a little bit more simpler, or in other words, net present value is the difference between present values of a project cash inflow versus the present value of a project outflow. So basically, net present value is trying to see trying to see how much money is being put into the investment and how much money will eventually come out of the investment. So net present value has three requirements within this idea. There's a positive net present value, a negative present value, a net present value of 0, and a negative net present value. For positive net present value, a positive net present value is acceptable, or in net present value. These three terms basically refer to if a project is acceptable or not, if it is worthwhile investing in this project or not. So a positive net present value, you can see it is acceptable because the rate of return is greater than the amount of money invested into the project or the future project. So it is acceptable because it promises a greater rate of return than the investment that we put in. For a net present value of 0, it is also considered acceptable because we're not losing anything, and it's acceptable. It doesn't harm the company. So a net present value of 0 is also acceptable. But a negative net present value is not acceptable because a net present value of 0 represents an investment which fails, or an investment which puts in a lot more money than than you can gain from it, or it does not promise a rate of return higher than the investment which was put into it. So when calculating net present value, there are two different types of net present values. They're basically the same thing, but the only difference is the rate of return of the money. Sometimes for a net present value, there is an even rate of return, which means that the money that we expect to get is always consistent and will always be the same value every year, which means if a company invests X amount of money, it expects to get $1,000 every single year consistently. So that is a net even cash flow, and then an even net cash flow is a cash flow which the inflow of cash might not be set or varies from time to time. So let's look at an example of even net cash flow. So Hishtop and Co. is in the process of buying a dump truck at a cost of $225,000 and expects to generate a net cash flow of $60,000 each month for 12 months. The company predicts the salvage value is 0. The target rate is 12% per year. So looking at this example, you can see that some of the variables within this is the initial investment of the company is $225,000, and it expects to get $60,000 each month from their investment, and they do not expect that the machine, the dump truck, will have any salvageable value, which means it will not survive or would not give another value, or they can't sell it off. They expect it to break down, or whatever the prediction is, that they expect the truck to not make it into coming year. So the target rate is 12%. So when calculating even net cash flow, I've listed out some of the the variables. You can see that initial investment J equals to 225,000. Net cash flow per period is